Central Bank of Kenya, for his kind invitation to me to participate in this historical celebration of the last 50 years of the Central Bank of Kenya. Indeed, this Golden Jubilee is no trivial matter. The average life expectancy of top institutions and corporate bodies in Africa is less than 50 years. Also, more than 80% of small firms, for example, Juwakari, succumb in the valley of death within the first 3 years of their birth. Nevertheless, CBK is right here at 50 and growing stronger. So it's not a trivial matter. I have been asked to reminisce about central banking. But rather than trying to demonstrate my age advantage of being a tiny bit older than CBK, I will try to draw some boundary lines, perhaps superficially, but in order to be able to make things manageable, and also to keep off the neck of the woods that will be covered by other speakers at this symposium. I have chosen to be very faithful to the proposed topic, reflections on central banking. But perhaps one could even go further and break this into the good of central banking and the unknown about the unknown of central banking. So there is some leeway in which one can interpret the reflections of central banking. But I will follow a very simple roadmap. First, I will try to code the policy milestones on the epic journey of central banking from the initial conditions, starting point, through the transition, and then on to modern central banking today, both in a global context and also in a Kenyan context. Then I will argue that throughout this epic journey, there have been some twists and turns. And although we have had many developments, tremendous developments in economic theory, in econometric evidence, and in policy and practice, still some issues have remained very entrenched and very difficult to resolve. I will simply highlight 5 of these issues. I could go further than 5. By the way, there is a paper that should be circulated around here which summarizes all these points. Futurology is quite tempting when we reminisce, but possibly I will skip the futurology in the sense that also the presentation by Mr. Furusawa detailed us so much into the future. Debate here and the indication by the chair is quite appropriate, mentioning the Swedish Riksbank 1661, and then the Bank of England 1694, and quite rightly, the Banque de France, founded in 1880, to contain hyperinflation and also to foster renewed economic growth during the French Revolution. But you see, the point here is really that the building blocks, the simple building blocks of the mandate of central banking today can even be traced in these initial conditions, i.e., we see the issuance of currency and protecting its value, as in the Banque de France. We see the lender of government in the Riksbank and also in the Bank of England initially. And now, of course, this could be extended to the lender of last resort. And then we see the clearing system, possibly precursor to the modern payment system. So the building blocks are there, and we need to appreciate that. And for the transition, also I'd like to be selective and possibly just pick out the Walter Bagehot milestone in a way in which it was transformative, the US Federal Reserve milestone, and the Bank for International Settlement milestones. Walter Bagehot, not alone but also a couple of other thinkers around his time, was just simply to react to the actions of Bank of England in handling financial crises, and proposing the responsibility doctrine, which required the Bank of England to subsume its private interest to public interest in the banking system as a whole, and then to lend freely on the basis of any sound collateral offered, plus, of course, a penalty rate of the maker that is above the market rate to prevent moral hazard. And so the dictum by Bagehot was, to avert panic, central banks should lend early and freely, without limit, to solvent firms against good collateral and at high rates. In a way, this actually stemmed off some of the crises that would have erupted and worked with some modifications. Okay. The contribution by Bagehot is then, of course, further refined by other thinkers, but actually worked tremendously to actually deliver some of the developments, at least for the transition. The milestones of the Federal Reserve in 1913 is actually had precedents of, they say, the Bank of America, kind of false starts found of problems with the issues of currency, but finally delivering the Federal Reserve to provide uniform currency and to serve as a lender of last resort, and therefore giving birth to the central banking system in the US. And of course, the other central banks in other countries also followed. But also this transition period saw the birth of the world's oldest international financial institution, the Bank for International Settlement, established in 1930 to foster international monetary cooperation and serve as a bank for central banks. Of course, problems arose. Problems arose in terms of being able to retain and hold back the impulsive actions of both the Bank of England and the Federal Reserve, which actually kind of temporarily brought to a stop the work of the Bank for International Settlements. But you see in the transition takes us a little bit further to the status quo. Sometimes when I mention the status quo, people say, but of course the quo has lost status in some forms. And this may be true in some banks, and mention Greece, mention Cyprus, and so forth. But it's an important milestone here is the creation of, here in the status quo, is the creation of the International Monetary Fund that the Deputy Managing Director has been highlighting following the end of World War II. And of course, with IMF in place, central banks started to refocus their monetary policy. Another important revolution actually also in this modern central banking is the role of the financial stability. But I know that this is going to be covered elsewhere in the day, so I will also sidestep that aspect of my presentation. Indeed, I also sidestep the aspect of the East African Currency Board, the milestone of 1919 that transitioned into the Central Bank of Kenya in 1966, in the sense that the next speaker I know will be covering some aspects of the future of East Africa, and I don't like to step on his toes. Now, what did we see from these milestones? What we see is, in reminiscence, that what has emerged from this epic journey of global and local milestones is that central bank has actually, the three main goals of central banks are established. Safeguarding the value of money and maintaining price stability becomes a primary role. Okay. Monetary policy is supposed to achieve this, but of course we see the modifications of quantitative easing, negative interest rate policy, NIP, and of course the proposal to scrap cash so that only money is electronic bank money, which are some of the proposals in vogue. Okay. And the second, of course, goal, to achieve high and sustainable economic growth. And finally, the third goal, financial regulation, maintaining financial stability. And I'll be going back to some of these goals as I go along. Gradually, central banking did deliver the great moderation with steady economic growth and low inflation in industrial countries, and with rapid growth and stable inflation in emerging economies until, of course, the outbreak of the global financial crisis quite recently. But also in reflection, this epic journey marks the evolution of the theory of central banking for people who've been following this. You see, here, what I map here is from my earlier work, is basically the flow of funds conceptualization of what is happening in the economy is in terms of whether you are taking the household sector plus the company sector, the bank sector, commercial banks, and other financial institutions, whether you are taking a look at the government and the external sector. The central bank here is playing an important role in this flow of funds framework to address asymmetric information problems among financial sector agents, real sector agents, and between the domestic economy and the rest of the world. Uses this information to provide a level playing field for all agents and to help to price risk by financial institutions and financial markets.